Stop watching the number on your phone. If you're staring at the silver ticker in New York right now, what you're seeing is not the truth. You see silver trading around $74.89. You see green candles flashing. You see a $3 surge and you assume you understand what's happening. You don't. What you're looking at is a shadow, a reflection, a paper illusion. You are watching a derivative market that is being choked by a liquidity crisis, unlike anything we've seen in 4 decades. If you want the real price of silver, the price that manufacturers and industrial giants are actually paying, you need to stop looking west and start looking east, 5,000 miles east, Shanghai. Right now, at this very moment, physical silver in China is trading at a premium that translates to nearly $80 an ounce. That's not a rounding error. That's a $5 gap. And in global finance, a 5-cent gap is an opportunity. A $5 gap means the system is broken. It means the arbitrage engine that keeps prices aligned across continents has snapped in half. It means the metal is moving in one direction only. And it means the New York price has no option but to jump higher to close the distance. Today is Boxing Day, Friday, December 26th. The markets are technically open, but the people are gone. We're in what professionals call ghost week. Senior traders are on vacation. Risk managers are offline. And the algorithms are running unchecked through an empty marketplace. In this investigation, we're going to expose the liquidity crisis unfolding on December 26th. We'll break down the math behind the Shanghai spread. We'll explain why U.S. bullion dealers have quietly frozen sales or raised premiums to $90 because they can T-replace inventory. And we'll examine the gamma wall sitting at $75. We are inches away. If that wall breaks in this thin holiday market, the move from 75 to 80 won't take days. It could happen in minutes. The paper price is failing. The physical price is asserting control. This is the story of the $80 squeeze. To understand why this is happening right now, you need to understand the calendar. Wall Street is run by humans, and the final week of December is the only time those humans disappear. Ghost week. Trading floors at JP Morgan, Goldman Sachs, and Citi are running on skeleton crews. Junior traders, interns, passive algorithms. The liquidity that normally absorbs shocks has evaporated. Picture a swimming pool. When it's full, you can jump in and the water barely moves. That's a liquid market. But today the pool is empty. Pour in a bucket of water and it splashes everywhere. That's in a liquid market. This morning, a large buy order hit silver and launched the price from 71 straight to 74.89. A $3 move in a straight line. Why? Because there were no sellers. The ask side was hollow. Banks weren't there to defend the price. They weren't there to absorb impact. So the price jumped. That's the danger and the opportunity of Ghost Week. When a motivated buyer enters this market, there's nothing standing in the way. Prices can rise 5 or 10% without effort. We are watching a vacuum melt up. And the most important detail is this. The buying hasn't stopped. So what triggered it? Why the panic the day after Christmas? China. Let's walk through the math. While the U.S. markets were closed for Christmas, Shanghai was trading. And in China, urgency is building. Solar manufacturers are scrambling to secure silver paste before year end. Battery producers are hoarding inventory. This pushed Shanghai prices to roughly 595 yuan per gram. Converted to dollars per ounce, that's about 77.20. And that's just the exchange price. Add VAT. Add delivery premiums on the streets of Shenzhen. The real cost to acquire physical metal exceeds $80. Now look back at New York. 74.89? That's a textbook arbitrage. Buy in New York, sell in Shanghai, $5 risk-free. That trade is acting like a vacuum, pulling silver out of London and New York vaults, loading it onto planes and shipping it east. That drain creates a shortage in the West. And when supply disappears, prices must rise to stop demand or attract metal. 75 isn't high enough. 78 may not be either. New York must rise simply to stop the bleeding. This is why the price is broken. 74 suggests stability. A $5 global spread screams dysfunction. The market is attempting to heal by repricing higher. Now check the American street price. You might think you can buy silver at 74. Try it. Visit a major dealer. You'll see out-of-stock notices, January pre-orders, or $90 eagles, $82 generic bars. Are dealers greedy? Maybe. But mostly they're scared. They're terrified of replacement cost. Sell today at 78 and face an $80 gap on Monday and you lose money. During Ghost Week, spreads widen for survival. Dealers are saying, we don't want to sell. This confirms the crisis. It isn't just paper liquidity missing. Physical liquidity is gone. Holders aren't selling, miners are withholding. Refiners are closed. Buyers are desperate. Sellers are absent. That's how charts go vertical. And now the gamma wall, we're trading at 74.89, 11 cents from ignition. In options markets, 75 is massive. Banks sold millions of ounces in calls at that strike. As price approaches, they enter negative gamma. To hedge, they must buy futures. The higher the price goes, the more they buy. It feeds on itself. Cross 75, and automated buying ignites. 75.50 triggers more. 76 follows. In a thin market, this can explode. No humans are there to slow it down. Algorithms chase each other upward. 78 becomes possible before the day ends. But there's danger. Thin markets can be manipulated. A single sell order could smash price back to 72 in seconds. A rug pull, stop hunts. If it happens, don't panic. It's structural, not fundamental. The $80 reality in China doesn't change. Dips are opportunities. Zoom out. Industrial demand is accelerating. Samsung. Batteries. Procurement officers are panicking for 2026. Tesla doesn't care about price. They care about production lines. Paying $5 more is irrelevant compared to shutdown costs. Industrial demand is inelastic. It's the floor. Every dip gets caught. Miners see it too. Costs are rising. Political risk is rising. They aren't flooding supply. Some are waiting for 100. A supply strike. Demand up. Supply down. Inventories drained east. This is a perfect storm. So what happens next? What happens when the clock hits 1 p.m. today and the market shuts down for the weekend? We fall into another 48-hour void. Then Sunday night arrives. And when Shanghai opens again, if the price pushes higher, if Shanghai prints 82, New York will be forced to gap again on Monday. This is price discovery in real time. The old price of $25 was a fiction. 75 is the awakening. 100 is the destination. But the path there will not be smooth. Volatility will be violent. Leveraged traders will be wiped out in seconds. This is why physical ownership matters. This is why unleveraged positions matter. You cannot ride a bucking bronco on margin. You will get thrown. Now let's talk about January. We are 3 trading days from a new year. Funds are watching this closely. If silver finishes the year near record highs, it triggers momentum systems for 2026. Pension funds look at the top performing assets of 2025. Silver is there, capital gets allocated. Billions of dollars move into a market that is microscopic by comparison. This move to 75 is not the finale, it is the trailer. The real volume arrives next week. And if China is already paying 80 without pension funds involved, imagine what happens when they enter. Now look at gold. While attention is glued to silver, gold is quietly anchoring reality at $4,500. This matters. If silver at 75 feels expensive, you are comparing it to the wrong thing. Compare it to gold. 4,500 divided by 75 gives you a ratio of 60 to 1. Historically, that is still stretched. In 1980, it reached 17. In 2011, 30. Geologically, 8. Even after this vertical move, silver remains undervalued. That is why smart money is not selling. They are looking at the ratio. If it merely returns to 30 with gold unchanged, silver reaches 150. That is the math driving algorithms. Silver is mispriced beta to gold. Now back to the dealer freeze. When a dealer sells you silver, they hedge by buying paper. That hedge protects them from volatility. But during Ghost Week, paper spreads are wide and dangerous. Hedging becomes expensive. That cost is passed to you. Worse, settlement risk rises. If exchanges halt or declare force majeure, the hedge fails. Dealers know this, so they stop selling. Inventory becomes sacred. This is why buy buttons vanish. Not conspiracy, survival. This brings us to the wealth transfer. For 40 years, paper assets ruled, bonds, stocks, promises. But with US debt at $36 trillion and interest-consuming revenue, the promise is broken. Inflation becomes policy. Capital flees bonds and looks for fireproof safes, commodities. The bond market is $100 trillion. 1% exiting overwhelms silver instantly. Silver must reprice higher simply to absorb the flow. It must become a $1 trillion asset. That puts price far above 200. Not desire. Physics. Now the psychology. Higher prices usually kill demand. But in currency crises, higher prices create demand. When silver rises $3 a day, people don't think it's expensive. They think it's protection. Cash loses value at the store. Silver gains value on screen. This creates a feedback loop. Mania begins. We are not there yet. When your Uber driver asks about silver, that's the top. We're early. Let's address the shorts. Commercial banks, bullion banks, swap dealers. They are short millions of ounces. They face backwardation, spot pricing above futures. This screams shortage. The market wants metal now, not later. Backwardation is fatal for futures systems. Shorts can't roll. They must cover. And in an illiquid market, covering creates air pockets. That's what you're seeing. Geopolitics matter too. China is paying 80 for more than solar. This is de-dollarization. Strategic metals equal strategic power. Control silver, and you control energy, defense, technology. China is exchanging excess dollars for critical metal. It's economic warfare. That bid doesn't disappear, it's policy. Eventually export controls come. Until then, arbitrage rules. Mining stocks lag because equity fear dominates. But at 75 silver, miners are trading at absurd valuations. Once capital rotates, miners can double in weeks. Missed metal, miners are the second chance. As we approach year-end, volume tells the story. Buyers are more aggressive than sellers, even with skeleton crews. Charts show blue sky, risks remain, margin hikes, halts, interventions. But these are system failures, not silver failures. Break the thermometer and the heat remains. Watch Shanghai. As long as Shanghai leads, trend remains up. Liquidity will thin further into New Year's. A final spike before midnight is possible. 80 to start 2026 is no fantasy. It's trajectory. Industrial reality confirms it. Just in time is dead. Just in case has arrived. Companies are hoarding. Off-market deals are draining float. Silver disappears into factories and never returns. This demand is forced. No substitutes, no delay. That creates a concrete floor. Solar demand accelerates. Thrifting failed. Efficiency requires more silver. Mines cannot respond. 70% of silver is byproduct. Supply is fixed. Demand is not. That is the recipe for vertical moves. Miners see it. They withhold. Supply strikes stack on shortages. Pipelines run dry. Banks wait with buckets. Nothing flows. January brings pensions. Performance chasing. Billions collide with no sellers. Add shorts covering. Add industrial demand. Add retail. That is how price teleports. Counterparty risk rises. ETFs promise metal they may not deliver. Cash settlement becomes theft during inflation. Physical ownership is protection. If you don't hold it, you don't own it. Silver rises against every currency. This isn't dollar weakness, it's fiat failure. Gold walked first, silver now runs. Weekend strategy is simple. Ignore noise, watch structure. Flash crashes are gifts. Banks are trapped both directions. Suppression era is ending. Now the psychology of selling. The urge is real. Green candles trigger fear. But selling silver for fiat is running into fire. Cash melts, silver preserves purchasing power. You don't sell silver for dollars. You bank in silver. You swap for real assets when ratios signal. The ratio is the exit. Above 40, accumulate. At 30, watch. At 15, swap silver for gold. That's how dynastic wealth survives. Ghost week remains dangerous. Rug pulls may come. Leverage dies. Physical survives. Looking ahead to 2026, every macro vector aligns. Solar mandates, commodity remonetization, debt ceiling chaos, bond panic, capital flight. The Boxing Day breakout is real. Banks lost control when metal vanished. They are now passengers. The train has no brakes. Hold the line. Liquidity crisis is the signal. Shanghai is the truth. Wealth transfer is underway. The squeeze is only beginning. Subscribe.